Imagine having invested $1,000 in PayPal in 2018. What would that investment be worth today, in March 2024? An intriguing question indeed. The answer might surprise you. That $1,000 investment in PayPal 5 years ago would have dwindled to $785 today, marking a 22% decrease since the initial investment. Interestingly, if we shift our timeline a bit and consider the same investment made in mid-2021, the picture becomes even bleaker. The investment would have plummeted by a staggering 4 times its original value. A significant downturn indeed, and one that likely raises a few eyebrows among those with a keen interest in the financial world. So, what's the story behind these numbers? Why has PayPal, a leading online payment company in the United States, seen such a decline in investment value over these periods? You might be thinking it's due to some catastrophic event or a series of unfortunate mishaps. But the reality might not be as dramatic, albeit equally impactful. The truth lies in the intricate world of financial and business data, a realm where numbers tell stories and percentages paint pictures. This is the world where we can find our answers. To understand the reasons behind the decrease in PayPal's investment value, we need to delve into the company's financial and business data. We'll explore their revenue growth, profit margins, net profit, assets and liquidity, cash flow, and finally, we'll conduct a DuPont analysis. By examining these aspects, we'll aim to shed light on the underlying factors contributing to PayPal's performance, thereby providing a comprehensive understanding of the company's financial health. Whether you're an investor looking to make informed decisions or someone merely interested in the fascinating world of finance, this exploration promises to offer valuable insights. So, are you ready to dive into the world of numbers and percentages, to uncover the story behind PayPal's declining investment value? Let's delve into why this is the case by examining PayPal's financial and business data. PayPal's revenue for 2023 stands at $29.8 billion. Since 2018, it's been on an upward trajectory, with a compound annual growth rate, or KGR, of 14%. Let's delve deeper into the year-on-year growth percentages to understand the revenue dynamics better. In the leap from 2018 to 2019, PayPal saw a revenue growth of 15%. The subsequent year, 2020, brought even better news with a growth rate of 21%. The trend continued into 2021 with an 18% increase, demonstrating PayPal's resilience and adaptability in a challenging economic landscape. However, the growth pace slightly decelerated in the following 2 years. In the transition from 2021 to 2022, the growth rate was 8%, and it remained the same in 2023. Despite this slowdown, the consistent upward trend over these years is a testament to PayPal's robust business model. Now let's take a look at how the revenue is distributed. A whopping 90% of PayPal's revenue comes from transactions, with the remaining 10% attributed to value-added services. This skew towards transaction-based revenue underscores PayPal's strength in its core business. Geographically, the United States accounts for 58% of PayPal's revenue, while the rest of the world contributes the remaining 42%. This geographical spread of revenue indicates PayPal's strong foothold not just domestically, but internationally as well. To sum up, PayPal's revenue growth story from 2018 to 2023 is one of consistent upward movement, albeit with a slight slowdown in the last 2 years. The significant contribution of transaction-based revenue and the substantial share of the United States in PayPal's revenue further underline the company's strong market position. This steady increase in revenue paints an interesting picture of PayPal's business performance. It showcases the company's ability to grow and adapt in a dynamic environment while maintaining its core business strength. As we move forward, it will be intriguing to see how PayPal navigates the challenges and opportunities that lie ahead. The net profit margin for PayPal in 2023 is 14%, a decrease from 20% in 2020. This downward trend is not a random occurrence but a result of a calculated shift in PayPal's business model. Let's delve a bit deeper into this. The primary reason for the decrease in net profit margin is the increasing proportion of costs to revenue. More specifically, transaction costs have seen a significant hike. In fact, the proportion of transaction costs to revenue has risen from 36% in 2018 to a whopping 48% in 2023. So why this increase? Well, as PayPal expands its reach and services, it's also incurring higher transaction costs. This is a natural progression for any growing business. However, this increase in costs, while necessary for growth, has led to a decrease in the net profit margin. But before you start worrying, there's more to the story. While the net profit margin has been on a downward slope, the net profit itself has been on an upward trend. In fact, PayPal's net profit in 2023 is an impressive $4.2 billion. To put this into perspective, if we look back at 2018, the net profit was considerably lower. The compound annual growth rate, or CAGR, from 2018 to 2023 stands at a strong 15%. This means that even though the margin has decreased, the actual net profit has increased. And this is a key detail. It's not just about the percentage, but the actual dollar value that the business is able to retain as profit. So, what does this mean for potential investors? While the decreasing net profit margin might be a cause for concern, the increasing net profit signals strong financial health and potential for continued growth. In conclusion, PayPal's financial landscape presents a fascinating study. The company is navigating through increased costs while still managing to increase its net profit. This balancing act is a testament to PayPal's robust business model and its ability to adapt and grow in a rapidly evolving digital marketplace. While the net profit margin has been decreasing, the net profit itself has seen a steady growth. Looking at PayPal's assets for 2023, we see a total of $82 billion. This shows a slight increase from 2022, where the total assets were recorded at $79 billion. The growth of assets over the year indicates the company's ability to expand and grow, which is a positive sign for potential investors. Now let's shift our focus to net assets. In 2023, PayPal's net assets were valued at $21 billion, up from $20 billion in the previous year. Net assets are a key indicator of a company's intrinsic value, and an increase in this figure is a good sign. It shows that the company is increasing its wealth, which can provide more security for investors. An important ratio that we should discuss is the equity to total assets ratio. In both 2023 and 2022, this ratio was 26%. This ratio gives an idea of how much of the company's assets are financed by shareholders' equity. A consistent ratio over the years suggests that PayPal has maintained a stable financial structure. Next, let's talk about liquidity. The current ratio for PayPal in 2023 was 1.29, a slight increase from 1.28 in 2022. The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations. A ratio above 1 suggests that the company is in a good position to meet its short-term liabilities with its short-term assets. Lastly, we should look at the receivable days. In both 2023 and 2022, PayPal's receivable days were 13. This figure tells us the average number of days that it takes for the company to collect payment after a sale has been made. A consistent and low receivable days number indicates efficiency in collecting receivables, which is a positive sign for the company's cash flow. In conclusion, PayPal's assets and liquidity figures indicate a stable and growing company. The consistent and positive figures suggest that PayPal has the ability to meet its obligations and grow its business. These figures give us insight into PayPal's liquidity and financial stability. PayPal's operating cash flow for 2023 stands at $4.8 billion. This is a slight decrease from the previous year and a continued downward trend from its peak in 2018, when it stood at $5.5 billion. The free cash flow too has been on a similar trajectory. In 2023, it clocks in at $4.2 billion, a drop from its 2018 figure of $4.7 billion. This downward trend indicates a potential need for PayPal to reassess its cash flow strategies and find ways to better optimize its operations. Now let's switch gears and take a closer look at PayPal's return on equity, or ROE, using the DuPont analysis. This breaks down the ROE into three key components: net profit margin, asset turnover, and the equity multiplier. In 2023, PayPal's ROE was 20%. The net profit margin was 14%, and the asset turnover stood at 0.36. The equity multiplier, which shows how much the company is leveraging its equity, was 3.9. Comparing these figures to the previous year, we see some interesting trends. In 2022, PayPal's ROE was 12%, the net profit margin was 9%, the asset turnover was 0.35, and the equity multiplier was 3.87. So what does this tell us? It shows that PayPal has improved its ROE, mainly driven by a higher net profit margin. However, the asset turnover has remained almost flat, indicating that the company needs to better utilize its assets to generate revenue. Despite PayPal's seemingly healthy financial data, the stock price has been dropping since mid-2021. This could be due to reduced investor confidence as revenue growth slows, increased competition in the e-commerce market, or potential market undervaluation of PayPal at this time. However, for the savvy investor, this could present an opportunity. Remember to subscribe to the channel for more analysis videos and leave a comment about the companies you'd like to see analyzed next.